Good morning, everybody. I'm Renee Laychur. I'm the Managing Director at Wheatland Advisors in Lancaster, and I'm happy to be here today. I've been working in investments for all of my professional career, which is a long time now, and I'm a CFA, a Chartered Financial Analyst, and one of my favorite things to do is to talk to groups of people, and particularly women investors. And I'm assuming that's who I'm talking to today because the title of our presentation is A Woman's Perspective on Investing. So let's get started. And if you do have any questions, I know they will be interrupting me, so waving their hands at me, so I will be able to answer them as we go. So wanted to start by talking, about women and their role in the financial and investing aspect of the world. And women are becoming a very powerful force. Right now, women globally exercise control over 11 trillion in investable assets, or about 40% of all the investable assets. 5 trillion of that is solely controlled by women. And this is a global force because globally, about 2/3 of women in the US, UK, India, China, Hong Kong, and Singapore consider themselves the primary financial decision maker over their household funds and investments. And I just wanted to start with this chart that I've shown to other groups of women, especially young women, about one of the reasons women are a more powerful force is because they're now, they've become, especially since this chart shows us in 1970, they've gone to college, become better educated, re-entered the workforce, and they've chosen way different careers than they did 70 years ago in 1970. And this is Census Bureau data. So, if we look at the more traditional roles that women had in 1970, the three big ones were registered nurses, dental assistants, and cashiers. Women are holding a lesser percentage of those jobs, and some men are filling those. But if we look at some of the higher professions, pharmacists, you can see women went from 12 to 52%. 60% of all accountants in America are women now. Physicians and surgeons, attorneys, and even historically male professions of police officers and civil engineers. While not a huge percentage, but more women are holding those roles. They're acquiring more assets, they're earning good livings, and they're saving money. And women do have some challenges in all of this. Challenges that are a little different than men's in some ways because we live longer. We unfortunately have probably saved less money, and because we live longer, we're going to need more than men. We've saved less money because we've probably made a little less than men, even in those careers. We're going to have higher medical costs and higher taxes, and we'll talk about those things. Some of them seem a little odd. But life expectancies in the United States, this is information from the CDC and the National Council on Health, and this is the latest data from 2018. At birth, the average life expectancy of an American in 2018 was 78.7 years. A little less for men, 76.2, and a little more for women, 81.2. So, when we're born, that's how long we're expected to live. However, the data changes dramatically if we're already 65. So if we're already 65 in 2018, we're expected, both sexes, to live almost another 20 years, or until about 85. So we're going to be in retirement a long time is the moral of the story, and the longer we live, the longer our life expectancy becomes. For women, that's 20.7 years, almost 21 years. And I decided to do a little fooling around on the Social Security website when I was putting this presentation together, and I made up a fictitious person who turned 65 on June 30th of this year. So you can plug this in, and the Social Security Administration will tell you what your average life expectancy is at 65. And this is even a little more, and this is for a woman, this is even a little more than we saw on the last chart, 86.5 years. And at 66 years, 2 months, which would be the normal retirement age of a person who turned 65 this year, it's almost 87. And at 70, which is the when you no longer benefit from not collecting Social Security, it's almost 88. So very interesting data there also. Same data for a man, a little less, but still very long time expectancies in retirement. And that seems to go up every year as we're all living healthier lives, doing the right things. I did a big talk on retirement a couple of years ago, and retirement has really changed. The kind of things people do is much more active now and really keeps us healthier and having a longer lifespan. Another way to look at it for women, and I found this on a study called Women in Investing, a Financial Guidebook for Women. It was interesting. In the US, there are 126 women for every 100 men at the age of 65. And that goes up to 187 women for every 100 men at the age of 85. So we are really living longer. Not only the projections show us that, but the current data shows us that also. This is a chart from Vanguard, which gives us the life expectancies in the green bar of men, the light blue bar of women, and the dark blue bar of couples, and the percentage the percentage that you're expected to get to that age from 65. So if you're 65, you're a couple, there's almost a 100% chance one of you will live to 75. If you're 65, there's about nearly an 80% chance one of you will live for 80 to 85, and almost a 40% chance one of you will live to 95. So really seriously, we need to be aware of our health issues as well as our financial health issues as we retire. And unfortunately, because women live longer, we're going to have higher health care costs in retirement. These numbers include long-term care. This is from a Merrill Lynch study. A typical man's health care costs are just shy of $500,000, while a woman's will be almost $700,000 throughout retirement. Again, increased lifespans, not really health issues. So, all this information, some of it's a little depressing, some of it's kind of exciting. We're living longer, happier, healthier lives. But what it means is we have to really, as women especially, make our money and our funds work hard for us. So when we do that, we're going to next examine kind of our financial goals, how men and women differ with investing in financial goals, and how we need to understand this to compensate for it. So really, both men and women have the exact same financial goals. We want a comfortable retirement. We want to maintain our lifestyle when we're retired. And we want to cover our health care costs for ourselves and our family. This has certainly been, the third one has certainly been a more predominant issue in the last 10 or 15 years, I'd say. When I started my career, I don't even think many retired people were as concerned about health care costs as they are today, but we know the costs of health care have gone up dramatically. Men and women do differ a little when they think about wealth. Both men and women see wealth as giving them the financial security and the independence they need to live a good life. 90% of women, they want to make a positive impact with their investments, and this is globally. They want to invest according to their specific values, and over half the women want to invest in companies that have senior leadership that's diversified, that has a diverse group of senior managers. This became such an issue in California that last year they passed a law that companies over a certain size, public companies, must have at least 3 women directors on their board, or there will be a fine, a penalty for not doing that. This is the base of ESG, environmental and social governance investing, which has become very important globally, particularly with women and particularly with younger millennial investors. But it's a trend that I don't see going away. A couple of more stats that we generally hear about women, many studies have shown these, is that women tend to take less risk, and when they do that, we're going to talk about this a lot later, accept lower returns. Merrill Lynch says that half of women feared losing principal. We're all afraid of that, but women seem to be especially so. Women often tend to rely on safe investments. Those investments aren't going to keep pace with inflation or get them ahead with their investing. And in general, women consider themselves less knowledgeable about investing than men. It's a Wall Street Journal article from 2015 by Georgette Jansen, very interesting article. It talks about the confidence level of men and women about investing, and men are generally more confident. Women are more goal-oriented, as we saw in the last slide. They trade less. Men tend to trade more. They tend to make snap decisions. And they tend to lose a little money because they don't research things as adequately as women. Women often seek professional advice. They seek a financial advisor. And if Fidelity looked at, Fidelity and Vanguard are two of the largest retirement providers in America. And 42% of women use financial advisors, only about a third of men do. So big difference there. At Vanguard, women are more likely to put money in their retirement plan, their 401k, than men, and they're more likely to choose a target date fund, which is a managed fund, which is more like hiring a financial advisor than a do-it-yourself approach. It's a little different. Nellie Oster said there's 3 significant differences. Women tend to focus more in the long term. They're more concerned about non-monetary goals. Their families, things that represent security and independence for them. Money's not necessarily just to buy a new car or to do things, it's to have security. Women are more likely to ask directions than men on investment decisions. Now, I think about this, and when I've talked about this kind of fact before, really, I remember the trip when we were kids, before GPS, in the station wagon, mom and dad in the back seat, my brother and I, mom and dad in the front seat, my brother and I in the back seat, map in hand from AAA, and inevitably, dad made a wrong turn. He was always driving. And mom said, let's stop at the gas station and ask directions, and dad never did. So I think we all kind of chuckle at that story, but it is much more true that women ask for directions. Women study their investments a little more. They take some more time in making their decisions. They don't snap into a trade. And these are generalizations, and that means they tend to trade less. USA Today says women look at the bigger picture and, again, say they research and seek help when they're doing investing. All of these are good things. All of these are great traits. When it comes to financial literacy, what we know about finances and investments in particular, men are much more likely to consider themselves knowledgeable. This leads women to pick more conservative investments that seem safe to them. Women much more often say, I don't want to take risk, where men say, I'm going all in, I'm taking a lot of risk. So really some different ways men and women think about risk, and especially in investments. But I just found this chart. It's very, very interesting. It's again from Merrill Lynch. This is a percent of women who feel confident about investing by generation. So if we look at the millennials, that's the cohort between the oldest millennials are turning 30, the youngest are about 40, I'm sorry, the youngest are about 25. Only about a little less than half of those women feel confident about investing, and they're really in the workforce in a big way. Gen X are the people between 40 and 55, essentially. A little more than half of those women say they feel confident about investing. Baby boomers, looking at the boomers, are between 55 and 75, and about the same percentage of those women feel confident. But older women, the silent generation, they feel very confident about investing. And this is years of experience, and it's a great sign that you know, as we become familiar as women and confident with investing and do it, that we're going to feel better about it. Conservative investing can be good in some ways. Taking a little less risk often causes us to have a little better returns. And this is, Forbes says women actually do a little better in some studies. And women, again, reiterate this throughout all of the research, trade a lot less than men. Now, women want to seek advice, they want to do research, but really only a little over a half of women in the United States have a financial advisor or use someone to help them with their investments. And of the women under 40, that's 3/4 of them don't have one. As a result, women who don't have an advisor tend to hold a lot more cash. And right now, cash is a 0% investment. We always need a little cash, but a fifth of their accounts in cash is probably not the best thing right now. And most women, even the ones who have an advisor, do say their advisor doesn't understand them and doesn't want to listen to them often. This is a big problem. Many women seek women financial advisors. There are very few. I think the total's around 1/4 of all financial advisors in America are women. I'm a CFA, Chartered Financial Analyst, which is really in my profession, it's one of the top designations, very difficult to get, takes 3 years. And I'm very proud of that accomplishment, and it's very worthwhile, and I get a lot of benefits from being a charter holder, a CFA charter holder. And I was shocked to learn a couple of years ago when I was doing some continuing ed that only 19% of all CFA charter holders globally are women, 19%. I wouldn't have guessed half, but I would have thought it was more like 35. So even if women want to find other women advisors, there are not many out there. And this chart is showing us that. It's also saying that 9 out of 10 of us are going to have to be the sole financial decision makers at some times in our life. So we need to know. We need to know what's happening in our accounts. This is very interesting. 70% of women leave their financial advisor within a year of being widowed. This is largely because I've been to conferences where the focus has been on women investors, and women are often ignored in the conversation when there's a couple. My Aunt Evelyn, my dear Aunt Evelyn, grew up during the Great Depression, lived to be 92. She had no children, so I was very close to her, helped her out a lot. My uncle died more than 10 years before her. After he passed away, she couldn't stand the broker. She couldn't stand the attorney, and oh, by the way, Renee, can you help me find a new accountant? So I know this really happens, and she was not a woman who ever worked outside of the home. She loved her husband and always respected his decisions, but this happens frequently because they paid no attention to her. Just a quote to end this section, that the financial services sector just hasn't gotten it quite yet, anywhere in the world. Women don't feel understood by their advisors. They feel they're not important, and somebody wants to put a cookie-cutter approach, and that needs to change. And you need to, as investors, if you have an advisor, ask questions. Really be more proactive with your advisor if you're not happy. If you're really unhappy, find somebody who can make you happier. But this is just a general trend in the market that women are not happy with their advisors many times. Got to switch gears here a bit. We're going to talk about investment basics. And I might bore some of you with this. I hope I won't, but I think it's always good to kind of get a little refresher on just the basics of investing and why it's important and how we need some tips for long-term success, perhaps. Why do we invest? I've used this quote from Vanguard for a very long time. Vanguard says it's simple, that we invest to create wealth. And investing is different than savings. When you save money, you put it someplace where you can get it easily. Where investing should be something that you're putting away for your longer-term goals, where you can take a little more risk and get a little greater return in exchange for taking that risk. And that is the premise of all investment decisions. The basics, the building block, is a trade-off between risk and return. And there are no free lunches, essentially. That's the old economic phrase. Simply put, the greater the return potential, the greater the risk of an investment. So if we have a very small company startup stock, that's much more risky than Procter & Gamble, Merck, Pfizer, companies that have been around a long time, which those are more risky than a 5-year government bond, which is more risky than a money market account, which is very liquid. The longer your time frame, the more risk you can take. You know, why is that? Because when I was 25, if the market went down like it did 10, 12 years ago and now, I still have a lot of time to make up for that. Whereas I'm getting close to that need for my money or those goals, I have to back off a little and put a little protection in. We need to diversify to reduce our risk, and that's by different kinds of investments, which we're going to talk about. And if we have very conservative investments like those down here, low risk, low return, the kind of things women often like, they can be too risky too. People say, oh, you're crazy. How can that really conservative investment be too risky? Well, that can be too risky because it's not going to keep up with the rate of inflation. Our money's not going to grow like it needs to be. We're going to be behind. So risk and return, very important. Now, we talk about investments. I can break them down to 3 basic types. There's literally tens of thousands of investments out there, but we're going to concentrate on these 3. First type is cash. It's not money buried in a mason jar in your backyard or under your mattress. It's stable short-term investments. And they have this asset class has the least risk. Moving a little bit up the risk ladder, we have bonds or fixed income. And when somebody talks about fixed income or bonds, they mean the same thing. They're income-producing investments, a little more risky, a little more return. Next, we have stocks or equities. And again, they're interchangeable terms. If someone's talking about the equity markets, they're talking about the stock market. And there are growth investments. They are most risky of the 3 investments. So we talk about cash. Some common types of cash investments are treasury bills. They're issued by the government. They're all under 1 year. They pay practically, all cash investments right now are very close to 0. Money market funds, the same. That's an investment that it's a mutual fund or a money fund account at a bank. Your money is always going to be safe. You're always going to put $1 and get $1 out, and you're going to earn an interest rate on that. Or short-term certificates of deposit at banks. These would be under 1 year to be considered cash. Longer ones would be considered fixed income, which is what we'll talk about next. So fixed income or a bond is essentially a loan. When I buy a U.S. Treasury bond, I'm lending the U.S. government money. The borrower agrees to, the U.S. Treasury agrees to pay the holder interest and pay me back my principal at some future date, which they specify. So here's an example. Let's say we buy a $10,000 bond of the ABC Corporation. The bond has a 3% coupon or interest rate, and it's going to mature 10 years from now on June 30th, 2030. ABC is going to agree to pay us $300 a year, and they're probably going to pay us $150 on June 30th and another $150 on December 30th. They're going to pay back our $10,000 on June 30th, 2030, and over those 10 years, we would earn $3,000 in total interest on that bond. So that's how a bond works. Now, the risk there with a bond is that, the corporation may go out of business before the 10 years, but bonds are pretty safe, especially when we buy investment-grade bonds. So bond prices do fluctuate. Unlike the cash investments, which stay stable, bond prices do fluctuate. They go up and down, and it works just like at this seesaw. We've got bond prices on one side of the seesaw and interest rates on the other side. As interest rates go up, bond prices go down. And as interest rates go down, bond prices go up. And just like a seesaw, the shorter our bonds, or the closer they are here, the less the price moves. The longer our bonds, the more they move. So if we owned a 2-year bond and rates went up, our price would go down a little. If we owned a 30-year bond, it would go down more. It's the math of the transaction. But bond prices do fluctuate. But they are one of the less risky investments. Our third type is our stocks, our equity investments. And when we own a stock, we actually own part of the company. We're an owner. We vote for the board of directors. We have other rights as owners, mergers, acquisitions, or to be bought out. We make those decisions by voting every year. Investors, they buy cash instruments for stability. They buy bonds because they want income, but investors generally buy stock because they want capital gains or higher prices. Prices will go higher. Stock prices do go higher. They sometimes go lower. They fluctuate, sometimes dramatically, and we've certainly seen that this year. If a company goes bankrupt, its stock is generally worthless. Bondholders are ahead of stockholders, so generally when a company goes out of business, the stockholders lose their investment. So this will be kind of fun. I was fooling around, found a total return calculator in stocks. It's called DQYDJ, and you could put in any investment you wanted. So I said, let's just pretend we put $10,000 in this list of stocks 20 years ago. On June 30 of 2000, what would it be worth on June 30 of 2020? This assumes that we reinvest our dividends, which dividends we're going to talk about on the next slide, but some companies' stocks give us part of their profits as a dividend. So Apple, a $10,000 investment in Apple grew to $1.4 million, and that's 28% average annual return. I was really surprised when I put Amazon in and it was less than Apple, to be honest. $755,000, still a great return. Amazon doesn't pay a dividend. Apple didn't the whole time, but now does. Microsoft, $74,000, 10%, 10.5% for the time. But we look at probably 20 years ago, Exxon was, if it wasn't the biggest market cap company in the S&P 500 in America, it was one of the biggest. And our return on that was far less than on our tech and our Amazon stock. And if we look at an old American stalwart like Ford, you can see we actually lost money over that 20-year period. So, we can make a whole lot of money if we own the exact right stock, and maybe if we owned Ford or a company like GE, we would have lost money. But you can see we do have vast differences, but in general, I've had some tremendous growth, particularly in technology stocks. That was just a little fun example. Talk a bit about dividends. As I mentioned, corporations sometimes share their profits by paying dividends to stockholders. Not all companies do. A lot of tech companies do not. Older tech companies do. Companies like Amazon that don't, growth companies, don't often pay a dividend because they're putting all of their earnings back into growing the company. Or some more established companies, they do pay dividends, and that does attract investors. These companies tend to be a little slower growing, but still very solid companies. You can just see what the companies do. Generally pay in America quarterly dividends. Dividends can be increased or decreased or cut out if a company's under financial stress. They're not guaranteed, but it is important when you're owning stock to look at the dividends. Now, the decision we make between how much money we're going to put in stocks, bonds, and cash, or asset allocation, is the most important decision we can make. It's going to affect our return far more than if we own Apple or Ford or this bond or that bond. It's the most important decision that we make. And how we determine that largely depends on our risk tolerance. Is one thing, and the time we have until we actually need the money. So, why do you have this crazy risk picture here? This was about a little less than 2 years ago. That's me scaling a wall on Over the Edge. I hate heights. It was a 6-story building. Thankfully, it wasn't a 20-story building. And that's my idea, my risk picture. So risk is very important. So, simply put, very simple chart. Says if we got a long time till we need this money, this was a retirement chart. We need a lot of growth and very little income bonds and short-term investments because, as I mentioned before, if the market goes down, We have a lot of time to make up for it. But as we get closer and closer to the point where we need that money, and we could have many different goals for our money, we need to have some more safe investments. I like to say our bonds, our short-term investments, they kind of act as insulation or shock absorbers to our portfolio. They will move a little, but not nearly as much as our growth or our stocks. The old rule for how you should allocate your assets between stocks and bonds / cash was take 100 minus your age. This was Jack Bogle, the founder of Vanguard, said this. So if I'm 20, I should have 80% of my portfolio should be in stocks. If I'm 50-50, if I'm 70, 30%. So this rule, it has been adapted a little bit lately because people are living much longer and because interest rates have been so very low for a long time now. So people are saying now maybe a better rule might be take 110 or 120 minus your age. So 120 minus 70 is about a half and half stock and bond portfolio. Just some kind of rules of thumb, but this chart's important to keep in mind. And if we plot out our main types of investments, this is a chart from Morningstar Ibbotson, who tracks a lot of data from the Great Depression through now, and they only do this annually, so it's updated at the end of the year. We plot, this is a risk-return plot. Here's our return, here's our risk. So least risk, least return are our treasury bills. That's money market accounts, cash investments. Here we have intermediate and longer term bonds, little more return, little more risk. Up here we have large company stocks. These would be the S&P 500, 500 biggest companies in America, the Dow Jones. Indexes like that represent large cap. And up here are small company stocks. These are companies, many of which, thousands of them, we've never heard of. They have the highest return over this long time period and the highest risk. Looking at this information another way, this is my favorite chart. This is a picture of risk and return in investments from the Great Depression in 1926 since the end of 2019. Again, Ibbotson Morningstar puts these charts out annually. Chart says this: something that cost $1 in 1926 at the end of 2019 costs $14. That's 2.9% inflation. Inflation's averaged about 3% over that long period. Keep that in mind. If I bought a cash investment, a treasury bill, the average return there is a little over 3%. If I go up here to my government bonds, my US bonds, 5.5%. But look at that. There's some places where this line moves around a little, where the green line does not. That's a risk that over the short term I could lose some money. But again, I'm getting a higher return. The blue line, again, is large stocks, the light blue line, the S&P 500, and the dark blue line is small company stocks. These lines look far different than the others. You can see the Great Depression. You can see lots of zigs and zags along here. It doesn't include our latest issues with the COVID market, but here's the Great Recession. But the moral of this story is, over the long term, these two lines, if we're patient, go up a lot more. And so in your asset allocation, stocks probably have some place depending on your risk tolerance. We do have bull and bear markets often in the US. Bull markets we love. They're markets that are up. Bear markets are down markets. And a bear market is defined as a market that's down 20% at least. So this is First Trust. This is all the bull and bear markets since 1929. You see a lot of them at the beginning in the Great Depression. The good news is the average bull market lasts almost 3 years, a lot longer than the average bear market. It lasts 9.5 months on average. We had a very long bull market, 11 years, ended in March, and it was the quickest, sharpest bear market ever. The market went down 34% in a month. And now it seems we're out of that because the market has recovered most of those gains. But bull and bear markets happen all the time. Crises happen all the time as well. We look at this picture from 1970. We have the oil crisis then, the stock market crash in '87. We've got the dot-com bubble and the Great Recession. Again, if we look at any one of these individually, they really give us a lot of heartburn and a lot of concern. But if we look at this period, since you've probably all been investing, a lot of people, you know, the market has done very well if we were invested long term, which is the big lesson that if we want to invest, like Vanguard says, we've got to be in there for the long term. If we're not, if we do trade, if we do try to get in and out of the market too much, we're going to penalize our long-term returns. Same Morningstar Ibbotson, my favorite picture here, says that if in the 20 years ended 2019, we owned the S&P 500 or some, you know, facsimile of it, the Vanguard Index 500 fund or an ETF that had the same 500 stocks, our average return would have been 6.1% for those 20 years. A little less than the long-term 10, but remember we've got the dot-com correction in there as well as the Great Recession. So two very bad markets, over 5,000 trading days. If we missed just 10 of those trading days, if in March we got out of the market on March 23rd when the market bottomed and we didn't get back in for another month, and we only missed 10 of the best days, our return was only 2.4% a year. This is 20. If we miss 20, we're flat. Our money went nowhere for 20 years. And if we miss 50, if we missed the 50 best trading days, less than 1% of the trading days, we had a negative 5.5% return per year. And the fact is that often some of the best days, biggest up days happen after some of the worst down days. So if we sell out on the worst down day and we miss a couple of great up days, this is what can happen. You can see this is the volatility of the market. This is a great chart. It shows us the benefits of staying in if we can. Going to talk about inflation because that's important. Prices go up. Sometimes we forget how much prices go up. We just, you know, we go to the grocery store, we go to buy something else, and we're just used to it. We expect prices to go up, and they do. But let's look at what things cost in 1975, and this is from most of this is from the Bureau of Labor Statistics, and 1975 was their benchmark year, the year Jaws came out. A pound of bread in 1975, and that's how they measure it, not a loaf of pound, cost 36 cents. A half gallon of milk cost about 79 cents. A new car was $3,500, and a new house was less than $40,000. How did inflation affect those prices till now? Bread at over $1.50, gallon of milk almost $3.60. New car, I just priced out like a basic Honda Accord, $24,000. And last year, new home prices in America were $272,000. If we look at those two sets of prices, it's stunning, but our money over that time period needed to grow faster than inflation or we would have been behind. That's important. Successful investing includes a lot of things, but it includes keeping all of our asset allocation, growing better, more than inflation, and many things in mind, including diversification. And diversification is not just stocks, bonds, and cash, but if I did a diversification chart for a client based on their risk tolerance, it would have many different asset classes. It would have large cap stocks, either growth or value, and mid cap, medium-sized US companies, and small caps, international stocks, maybe some emerging markets, as well as our fixed income, which could include many kinds of fixed income, including government bonds, corporate bonds, high yield bonds. So it's a complicated picture to diversify really well, but diversification is important because over time it reduces risk. Quilt chart, Callan. This, not important to really look at this in any other way other than to say, you know, these colors move around a lot. It looks like a quilt. This represents an asset class. These are large cap stocks. This is cash. So last year in 2019, cash was the worst performing asset. Large cap US stocks were the best. There's, let's see, in 2008, cash was, well, actually, 2018, cash was our best performing asset. It was a bad year in the market. And large cap stocks were down here. Owning a mix of these, because they all move around, is diversifying your portfolio, and it makes sense to do that because no one knows what's going to happen next. So most of the time you can see the light blue cash is low to the bottom, but when the markets are very volatile, cash and bonds, the green boxes, make some sense. This is just this year. So you can see at the beginning of the year, bonds were doing very well because rates went down. Stocks were in the middle. And in March, you can see everything was negative actually in March, but picked back up. Now we can see our stocks are doing very well as international, and our bonds are near the bottom. So again, if we owned all of those asset classes and a percentage that was right for us, we wouldn't be at the top or at the bottom. We'd be somewhere in the middle on any given year. And a good way to diversify your portfolio is to own a fund, is to hire a manager, which is buying a fund, a pool of funds, managed by a professional based on many different objectives. You can essentially buy a fund that includes everything or very specific things: large cap, mid cap, small cap, international emerging markets, certain kinds of bonds. Funds have a lot of advantage. There's low minimum investments. They're very flexible. They're very diversified, and they're generally low cost. So funds are a good way to diversify your portfolio. Mutual funds are the oldest way to do it. They've been around for a very long time. They price at the end of every day. So if you want to buy or sell, you wait till the market closes and you know your price. Exchange-traded funds trade like stocks, and they're relatively newer. They've been around for 20 or 30 years, and those are very also popular now as well. Talk about the current economic situation for a moment. At the beginning of this year, we were still in the longest economic expansion on record in the U.S. It was over 11 years. No one could see a recession coming because the economy, at the beginning of the year, the U.S. economy was good. It slowed down a bit, but still growing. And we were all looking for a decent year, maybe a little slower than last year and the year before, but a decent year. Things looked good. And then we had a black swan event, which is an unprecedented or unforeseen event, typically with extreme consequences. And that's what the coronavirus, the COVID-19, has been. Kind of looking back on a picture of the stock market, which we haven't seen so far year to date. This is a 30-year picture. We can see the past dot-com bubble and the Great Recession, downtrends in the S&P 500. This was the COVID pandemic. Again, the shortest, steepest correction bear market ever in the U.S. happened in a month. Looks like we're out of it now because we've really not quite back up to our highs from February, but we're about flat for the beginning of the year right now in the S&P 500, so it could also be the shortest bear market ever. So stock market is assuming the economy is going to do better. Stock market's forward-looking. We continue to see economic activity improving. We've seen retail sales improve. We still have very high unemployment. The unemployment rate peaked at 14.7% in March, which was the highest unemployment in 80 years. It's gone down to 13, 11, but it's still very high. There's still a lot of people unemployed. There's still a lot of issues with businesses that can't reopen, and now we're seeing, particularly in the Sun Belt, the Southwest, up through California. We're seeing increased cases of COVID-19. So on any given day, the market's very nervous about that. Very, you know, what we are focusing on are in the US, are cases of COVID, and additionally treatments as well as vaccines. And there have been some positive news on that lately. So stock market has been doing much better, and it has recovered. And if you didn't get out and you had stocks and you're still in, you're probably about even. Interest rates were very low even before this pandemic happened. And during the pandemic, the Fed has lowered rates to near zero again, like they did during the Great Recession. So this is long-term treasury rates, a 10-year treasury, kind of a proxy for the market, for the last 50 years. And I like to say this is kind of the story of my life. I literally started my first job in investments right here in 1982, when rates peaked at about 16% on the 10-year and short-term rates were 20. But we've had a very long decline in interest rates, and that became very sharp, especially during the Great Recession. And then we just kind of bounced around, and now we are at historic levels. We were at historic levels. This is the past 15 years, same picture, just focusing in on the end. We were at historic levels here in 2012 and 2016 at about 1.5%. The 10-year treasury is now at 0.6%. So if you buy a 10-year treasury bond, you're going to get 0.6% a year. What's inflation? Inflation's around 3%. Even though inflation is low right now, it's still 1 to 1.5 to 2%. So well below inflation rate on a 10-year treasury right now. Let's take a look at what that means versus a year ago. So I just put it in this perspective. You can buy CDs on the open market. You can sell them. They're very easy. They have the FDIC protection. So it's a nice conservative investment, and it often, longer ones, look much like a bond. So last year, looked at a Capital One 5-year. We could get 2.5 on that due in 2024. Our annual interest was $1,250. Pretty good. Rates were like making me a little happier last summer. Look at where we are this year. Same 5-year CD, less than 1%. A little higher than the 10-year treasury, which we should be, but less than 1%. So what's your alternative if you need some income in your portfolio? Well, one thing we might want to look at was some, not all of your investment, maybe even a part of your fixed income portfolio, is some dividend paying stocks. And I picked Procter & Gamble for this one. It's a company that's been around since 1837. We all know the brands Tide and Bounty and Charmin, Cascade. We all know their brands. It pays a decent dividend. So I just said, instead of buying that CD last year, why didn't we buy $50,000 worth of Procter & Gamble? And that's 452 shares, and we paid $110 and a little less than $50,000. We got dividends of almost $3.03 a share, totaling over $1,300. Stock was up a little year over year, so we made a little money. Its current yield was 2.65. And we had about a 10% return, our dividends and our price appreciation. P&G increased their dividend this year. That's 27 consecutive years. So one of the benefits of holding some dividend stocks is when you own that CD or that bond, you know exactly what you're going to get every year in interest, which is good. But with a dividend stock, sometimes you can get a little more. And even if the price goes down, you have that dividend to protect you a little. Again, just an idea, and not selling Procter & Gamble, but just a big company idea. You can see from this Ibbotson chart, this is high dividend paying stocks. Procter & Gamble and the companies the big, boring kind of value companies would be this red line, and this is the S&P 500, regular stocks. You can see that, over the last 20-some years, dividend stocks have done a little better. The dividends have helped because you've gotten cash where a lot of these stocks don't pay you anything. And a good way to do that is, again, by using a fund. And again, not selling anything. This is just a fund that I like. It's an index fund from Vanguard. This is the ETF. You can buy the mutual fund or the exchange traded fund. It's the Vanguard High Dividend Yield Fund. And instead of owning just one or two stocks, you own pieces of 482 with this fund. The fund's been around since 2006, and the current yield's a little higher. It's 375. So these are the top 10 holdings. This was as of June 30. You're going to own Johnson & Johnson, Procter & Gamble, JP Morgan Chase, Intel, Verizon, AT&T, Cisco, Merck, Exxon, Bank of America. So you're going to own a lot of big American companies. So just maybe a little easier way to own some dividend payers as we look at this really low interest rate environment. It's just a bit of an option right now. That's all I have to say today. I'm happy to answer any questions. We have questions?
We have one viewer asking, they are looking for an accountant and wondered, what do we do to look for one when trying to find a reasonable accountant? What sort of questions should she ask about making the choice?
For an accountant or a financial advisor?
She says accountant.
So I have a lot of accountant friends. I would just want to ask about their experience. I ask some friends for recommendations. I think that's always a good thing to do. But I want to ask about their experience, how long they've been in the business, and how if you have specific issues with that you need an accountant for, ask if they specialize in those. Off the top of my head, I own rental properties or real estate outside of my other assets. Do you have experience doing that? Or other, other specific things you might have. If you're looking for a financial advisor, you need to again, because we talked about financial advisors, you need to again you need to have a comfort level with everyone. The other thing, and I'll go back to any professional you hire, you probably want to ask them about their costs, their fees. How do they compare? That's important. Would you buy a new car without knowing the price? Would you just go in and say, hey, Mr. Car Dealer, I like that black car over there. I'll write a check. No, you wouldn't do that. So do the same thing with the professionals that you're working with. Hopefully I answered that question. Anything else?
No other questions.
Okay. Well, I hope that I've given you some reasonable information. If you have anything that you want me to follow up on, Jennifer, I'm sure, would be happy to do that, and she can get in touch with me. So thanks a lot for your time today. I really appreciate it. Spending some time with you. I wish I could have done it in person, but hopefully someday I'll be able to. Thank you.